And good afternoon, everyone. It's such a pleasure to see so many of you today. I'm not seeing very many because most people are off their cameras, but it's great to see the turnout so far. So welcome. Just a bit of housekeeping before we get started. Do keep your audio on mute, please. We do feel free to keep your video on if you'd like, but keep your audio muted. Also, please introduce yourself in the chat so that everyone knows who you are. You can also comment or ask questions in the chat anytime during the discussion. We'll be monitoring those and we will try to respond to as many questions as possible. So just keep them coming. So my name is Nadia Martinez and I lead the Secretariat of the Smallholder and Agri-SME Finance and Investment Network. For those of you who don't know us, SAFIN is a network of organizations working across the agri-SME investment landscape. And we're working collectively to advance inclusive finance for agri-SMEs and to reduce this persistent finance gap by addressing bottlenecks at the ecosystem level. So before I kick us off, I'd like to thank our co-host at Market Links, my SAFIN colleagues, and especially our panelists, Songbei Lee, Jovitas Ruta Kinikwa, and Wouter van der Stuypen, who agreed to share their insights and experiences today. They will introduce themselves directly and their organization, so I won't do that now. But Karina, I do also would like to ask you to say a bit about Market Links.
Yeah, sure. Thank you, Nadia. Hi, everyone. My name is Karina. I'm the point of contact for Market Links. We're a knowledge dissemination platform for USAID focused on market systems development. We've been providing communications and backend support to SAFIN for this webinar, but we will be hosting some posted resources on our event landing page. So be sure to check out our website after the webinar. Thanks.
Thank you very much. So this conversation with practitioners today is the first session actually of a three-part webinar series where we're trying to tackle various aspects of agri-SME finance and from different perspectives. So you'll see, we'll hear from donors, we'll hear from banks and investment funds. Today, we want to take a deep dive into what it takes to reach the millions of small businesses that operate at every level of the food system, that are the engines of rural economies and that often are the key to smallholder livelihoods. So these enterprises, we know, cannot grow or even sometimes survive without some level of financing, which is really hard to reach for all small businesses. The challenge is even compounded further by the fact that these are in agriculture. So the panel today will talk about the impact of agri-SMEs, we'll dig into the economics of financing them, and we'll discuss what donors can do to support investors and other organizations that are trying to innovate in the space. So again, please type your comments and questions in the chat. Enjoy the conversation. And Songbei, over to you.
Thank you very much, Nadia. Briefly, I'm Songbei Lee. I am the Ag Finance Team Lead at USAID, based in Washington, D.C. I've been here for about 3.5 years, and it's really great to be here. And so just going to jump right into it. We don't have a lot of time and a lot to talk about. So I just like to start out by having our two panelists introduce themselves briefly and their organizations. So Jovitas, why don't I start with you?
Thanks. Good evening, everyone. Hello, good evening, everyone.
Hi, we can hear you. Go ahead.
Okay, this is the Jovitas Ruta Kinikwa, newly appointed country manager, SME Impact Fund Tanzania. I was been appointed from January to head this the SME Impact Fund department in Tanzania. Otherwise, I have stayed with the SME Impact Fund for 10 years as a credit risk manager. That's it.
And can you just maybe, we're going to talk a lot more about the SME Impact Fund, but maybe just give kind of your 30-second elevator speech of what it is and what you do.
Okay, fine. SME Impact Fund is a non-banking financial institution dealing with the financing the agribusiness. We finance the SMEs in the agribusiness sector, traders, and processors, those who add value into the small orders, farmers' products. Our ticket size is between 50,000 euros to 500,000 euros.
Okay, thank you. Great.
Uh,
Wouter, who let me pass it over to you.
Thank you, Songbei, and thank you very much for this opportunity. So my name is Wouter. I'm the executive director of Kampani, the founder of Kampani. We are based in Brussels. We are an impact first impact investment fund, and we provide patient growth capital for capex heavy investments. We do so using mostly subordinated debt with relatively small tickets indeed, between 100 and 500,000 euro. Our average ticket size is 350. And so with our investment, we allow our clients to, we finance these capex, meaning land, buildings, machinery, always long-term, always, of course, productive assets. And so it allows for a vertical integration, expansion, or a diversification. I'll leave it at that for now. Thank you.
Great, thank you. I just want to jump into so many different parts, but I'll try to maintain some discipline to keep us moving forward. So we're talking today about the S in SME, the small and medium-sized enterprises. So what does that really mean? Just to set some, what's the term? Just to give a definition so we're all on the same page, because it can mean so many things. Often I try to think of it just as transaction size. To me, if you ask, if I want to know one thing about a fund or a bank, the type of lending or investing they do, I think you could learn the most by looking at the transaction size. So one definition of transaction size for SMEs, agri-SMEs specifically in Africa, used by Aceli Africa, which is a USAID partner, are loans between $15,000 and $1.75 million. So that just means, often called the missing middle, these are SMEs that need money that's too large for an MFI, but still not quite large enough for a standard commercial bank to lend it to them without help. So today, I think what you heard from these brief introductions, we're talking about the space below $500,000, 500,000 euros. And the interesting thing is this is not an intro webinar. We're trying to get a little deeper in the weeds. And what you realize, to understand how to target these segments, or even if we should, you need to start segmenting the sector even further. So they did introduce themselves. I want to make some kind of summarize what they said, because I think it's easier to understand the type of organizations that are that way. Because when we introduced them, when we invited them to the panel, it was because they are similar in the sense that they're doing these sub 500,000 euro transaction sizes. But as you'll discover, besides that, almost in every other aspect, they are different. So we're going to try to see, and at the same time, they are both very unique. So Kampani, geography, global. And Javidas, do you call it SIF, SIF? Well, how do people? Oh, you're on mute.
You normally call it SIF.
SIF, okay, so SIF, one country, Tanzania.
Yes.
The product, Kampani, equity-like. SIF, debt. Transaction size, and we'll talk more about this later, but I would say that the average exposure, and we'll talk about, is going to be higher, over 500,000. The average exposure for SIF under 500,000. The tenor, up to 10 years for Kampani, typically only up to a year for SIF. Use of proceeds, Kampani, CapEx. SIF, working capital. So almost on every topic, or every point, they are doing different things, but they are targeting the same sector. So really looking forward to diving in. So we have an hour. roughly going to break it down. We're going to spend about 10 minutes on the how, 10 minutes on the economics, 10 minutes on the impact, and then make sure we leave some time for Q&A and then wrapping up. One thing I just can't help myself though, Wouter, is you said your impact first. And can you just briefly tell me what is the difference between impact first and I assume the opposite, finance first?
Well, I guess it's the overarching goal, what takes precedence. For us, Sangbei, it's actually quite simple. The fund economics of Kampani are such that it's the niche that we occupy, the type of investments that we do, cannot be done with purely commercial logic. And so in order to justify our activity, the social impact needs to be part of the equation for any investor. Purely from a risk-return point of view, it's a non-starter Kampani. So a heavy focus on the impact is inherent to our approach. The small farmer is absolutely central to what we do.
I think this is just an important point, and because I often will hear, about people making investments where there's, quote, no trade-off. But I do believe that when things come to push or shove, whatever the term is, one is going to take precedence. And what you're saying is what's a priority is going to be the impact over the financial return, which I agree with. And now I'm not saying it's wrong for other investments, like maybe in renewable energy. If that is your goal, you're likely going to get good returns, maybe even better returns with a social return. But in agriculture, what we find and what we'll be discussing about is that it's likely not possible, especially at the small ticket sizes. So it's just a point, not saying one is correct or not, but definitely in our case, we do see we have to make kind of a choice between, and there's that tension. A little bit more also kind of like ground setting is talking about definitions. And this is, sorry, it's a little pet peeve I have, or about how do people use terms and mean different things. And one thing I've noticed in this agricultural sector is the shift of who we're targeting. I mean, on one hand, we used to work, USAID as an agency would work more directly with smallholder farmers. And then a lot of the work went to what we call now agri-SMEs, but those used to be called just cooperatives. So I get confused. I don't know if others do as well. Are they different? Is there just a Venn diagram? Wouter, in your mind, has the focus shifted away, first of all, from smallholder farmers? Because actually, originally, the first report I read by Dahlberg in 2012, over 10 years ago, was called Catalyzing Smallholder Agricultural Finance. Second, is it important to distinguish between agri-SMEs and co-ops? Because I think Kampani will finance cooperatives, but I don't think SIF does. And second, what is your definition of an agri-SME by transaction size? I know you guys have a target. Is that your definition, or is that just a subsegment of a broader definition? So Wouter, let me ask you first.
There's a lot of questions wrapped into one there. For me, for Kampani and our approach and how we work, there is a big difference between cooperatives, meaning businesses or legal entities that are farmer owned, where the decision making is one farmer, one vote. The leadership is elected by and comes from the membership itself. This is the nature of a cooperative. An SME is in nature completely different. We usually just a few shareholders, the founders. It's they that call all the shots. They run the show. And so in the relationship that we have with these clients, it's about half at the moment, half our portfolio, total of 20 deals. So about 10 are with cooperatives and the other 10 are with SMEs. And I find that the nature of our work, the nature of our relationship is really quite different. So for me, this distinction is helpful. And I find that quite a lot of funds make the decision not to invest in cooperatives. They do have a number of characteristics that adds to the risk profile. And we believe we're equipped to deal with that, but I respect the decision of other funds to stay away from them.
So this is, I think you said the points I was hoping you would, that there is a big difference. And I thought it's just been very interesting how they've been grouped together. I think partly because agri-SMEs became the new flavor of the month for donors. It just sounded better, and they just included cooperatives. But I do agree, cooperatives as a segment have very different issues than agri-SME as a business. So is it, for SIF, do you choose not to finance cooperatives specifically for any of the reasons that Wouter mentioned?
Yeah, thanks. First of all, in East Africa, particularly Tanzania, there used to be cooperatives. There is no currently, there is rarely few cooperatives. So very rare. So we approach the individual companies that is maybe registered or sole proprietors. Those are the ones we are financing. We are not financing that directly to the primary producers that are small order farmers, but we finance the intermediate, those who buy the crops of the small order farmers. So by so doing, we assure the small order farmers with the market of their products, but also the prices that since the buyers have money, they don't borrow, they don't buy on credit. And also they can, we encourage what we call contract farming, that the SME financed by SIF can pre-finance the small order farmer to do the production, and they have a formal or informal contract where after the harvest we supply to the SME.
Thanks, Jovita. So yeah, it's a good point that cooperatives I've known have always had a stronger presence in Latin America, but I knew there were fewer in Africa, but I did not realize that they have been disappearing. Do you know what's been happening to the cooperatives in East Africa? Is it governance issues?
Of course it is, because they were, I remember in those days when this socialism, it was the government leading those, intervening into the businesses, making decisions, collecting the cooperatives are almost under the government.
Got it.
And
Okay.
now we are encouraging private investment, therefore cooperatives are naturally disappearing.
Interesting. And I think it's a common statement that folks say now that yes, even though we're working with SMEs, we're still reaching the smallholder farmers for the reasons you said. Do you have a minimum? And how do you measure that? Is it just a description, or do they have to sell product to a minimum number of farmers' inputs? Do they have to buy, the crops from a certain minimum number of farmers, or is it just the fact that that's part of their business model?
No, we encourage them to have and even at the baseline, we finance those who are sourcing from the farmers at least 25 small order
25.
farmers. Yeah.
Sourcing. Okay. And do you make a distinction? And do you make a distinction between if they're sourcing, it has to be from 25, or if they're selling, does it have to be a much higher number, because that's a different type of relationship? If they're selling seeds, do you have a much higher requirement, or is it really the main requirement is that they source from farmers?
Yeah, the main requirement is that they source from farmers, but the minimum at least that we can consider is at least they are sourcing from not less than 25 small order farmers.
Wonderful. Okay, thank you. This is we had a little discussion about this, but I do like you to touch on it. And this is there's a great article that there's on that Wouter wrote in SSIR, the Stanford Social Innovation Review, and has a great description of their model. And when they talk about the product, it says equity and equity like. So when I read it like that, it makes me think you do a lot of equity. But I think after we discussed it, that's not true. So can you explain, like, why isn't it the case, and then still why is it important that it's equity like?
Sure. Thank you. Indeed, I mean, Kampani was created some 8 years ago now, And at the outset, we thought we really needed to do quite a lot of equity deals. We had set out to do 2 out of 3 deals with pure equity because we felt that we needed the promise of the upside in order to make the fund viable. But quite early on, we realized that the type of businesses that we are interested in and that absorb or have a need for these kind of ticket sizes that we're talking about. Mind you, these are businesses that have a turnover of $500,000, $1 million dollars annually. So these are small businesses indeed. And so, with that comes also, if you will, for lack of a better word, level of sophistication. It's, making or attracting outside capital is simply not their core business. And so doing an equity deal, a shareholder agreement with drag-along rights, tag-along rights, bad lever clauses, all of those things, it gets incredibly complex very quickly. And so a lot of our clients simply are not equipped to negotiate usefully a deal like that. So that was the main reason, or an important reason, why we moved away from pure equity, and why now out of our 20 deals, 18 are actually subordinated debt, so quasi-equity. It has other advantages, but just to keep it short, for us, these 2 instruments, in terms of the ultimate objective that we're after, they are indeed interchangeable. Because ultimately what we want to do is strengthen the balance sheet. This is the core problem of a lot of these small businesses. They are unable to set aside profits, and the profits are upstreamed to the members. The members are poor, they have cash needs. And so, especially with cooperatives where, like I said a minute ago, the governance is a democracy. The General Assembly decides, the farmers themselves decide what to do with the profits. And so in essence, they are upstream to the farmers. And so that leaves forever a cooperative with a very weak balance sheet. And that is what we are designed to address, is to unlock that. Because with a stronger balance sheet, you can create a leverage on that. You can again borrow at better terms with local banks, with social lenders. You can invest long-term. So that is why we exclusively do quasi-equity or equity. In our case, it's almost all subordinated debt indeed.
And it's interesting. And just to build on the example, you said that, let's just take a cooperative, for example, that, one benefit is they pay, quote, like dividends to their members. But if a farmer has a choice, or they need that cash for their living expenses, but the other alternative would be investing it back in the business. But if they need that money to pay for their kids' school, they don't have that opportunity. So this is why the type of financing you provide for growth is so important. On the other hand, Jovitas, the type of financing that SIF provides is much different. Instead of long-term equity-like, yours is short-term debt-like. Can you explain how that works for SIF in your context, and have you ever considered doing longer term, more equity-like instruments?
No, we're actually doing short-term loans because we are typically in the traditional food crops, and these are seasonal. So we are doing like a revolving fund that every year we provide a loan to the SMEs. They buy crops from the farmers and then they trade. They get out of their cash flow, they pay our loans. Then they can add up next season, they take a new loan. That's how they manage their cash. Otherwise, yeah.
And I think the interesting thing is, so these are seasonal crops. So you're
Yes.
doing more production, which is
Exactly.
very high risk and most people avoid. But also, are you doing cash crops or local value chains?
No, it's not. There, we are at least we have less than 2%. We have done this in coffee. At least only one value chain, that's coffee. We did it twice, but no other cash
So
crops.
so the crop is mainly which crop?
It's food crops like mostly rice, maize,
Rice and
sunflower
maize.
oil.
Okay.
Yeah. Mhm.
And because I think the existing working capital finance out there is short-term working capital like you described, but primarily for cash crops like coffee and cocoa. So the niche you're providing, it's the same product, but for different value chains. And also, I think we'll be talking about later the geographies that you target. And Wouter, so then your borrowers, are they accessing that type of seasonal working capital from other sources?
Yes.
Okay.
Not so much because the type of the SMEs we are financing, they are very big for the microfinance because the microfinance are providing very little, very low or small scale funds. While the banks will give bigger money, but to the well-established companies because they need bigger collateral, they need other for more, they need to be on the next level of formality.
Got it.
So, yeah.
So Wouter, I think you were saying or about to say that your borrowers might have existing relationships with traditional social lenders providing that short-term working capital?
That's correct. Yeah, especially those that are going for cash crops, they tend to have indeed an existing relationship with a CSAB member, with a social lender, or with a local bank for their operating costs there, or their trade finance. Yeah,
Great. So so CSAF, Council for Smallholder Agricultural Finance, a network of social lenders, great website to check out. They have a lot of great data and examples of lenders doing the type of work some of the work we're talking about now. I want to stay with you, Wouter. And when we talk donors, we talk about interventions in ag finance. A simple way to look at it is we talk about increasing the supply of capital, and that's a lot of it's de-risking lenders with things like guarantees. We talk about the demand, increasing the demand for that capital by using technical assistance to build the capacity of those SMEs to borrow or to attract an investment. You talk about something in your SSIR article called appropriateness of the financial instrument, which is talking about that space in between. So it's not even increasing either side, but sounds like matching it better. What do you mean by appropriateness?
Yeah, thank you. Indeed, I mean, I approach this element mostly from the supply side. So supplying financing to this sector, it's indeed about accessibility, it's about affordability, and then indeed appropriateness. In appropriateness, I mean that a dollar that is lent for a year, and that is senior debt does not allow you to use it the same way as a dollar that is lent to you for 7-8 years, and that is junior. So the type of investment you are able to do with these different types of money and the types of investments are different. And so it's the strings attached that make certain types of sources of money more appropriate than others for any given type of investment. One is not better than the other, but not all types of money are appropriate for all types of needs. There are just different types of financing needs, and you need to tailor it to the need.
And one thing that's been interesting for me, Wouter, is that I've only recently learned about Kampani's existence, but I've been hearing about it a lot in that short time. And I realized is part of the reason because you are giving long-term loans or subordinated loans, convertible loans, equity-like products over such a long tenor. It's taken 10 years for you to see if the model works or not. Is that a right way to think of it?
Yeah, in part, it's absolutely true. I mean, everything we do it takes a while. We've only exited from our very first investment just last year. So if you want to see the results of what we do, some of it you need to be patient. Inherently, also in what we do, almost all of our investments include a construction phase. So sometimes it takes a year or longer to build what it is we finance. And then if you work in a crop that is an annual crop, then it's again another year before you see even the first impact. So yeah, that could well explain why we're not.
And when you say exit, just to be clear, you're not are you talking about selling an equity investment or a self-liquidating loan?
No, sorry. To be clear, it's indeed the last repayment where we're fully
Okay, the
out.
last repayment. Okay, great. Which is still great when you're talking about a long-term subordinated loan. Exits, full repayments are definitely what you're looking for. And I'm sorry, will that be likely the loan that repaid, the first one, will you likely extend a new loan to that same borrower, or do you try to not have repeat borrowers?
No, we like to do add-ons or indeed have repeat borrowers. We've done
Okay.
4 add-ons so far. In fact, the one that we just exited, again, the wrong terminology perhaps, but so is actually one where we did an add-on. And we are not able to continue working with them, unfortunately, and it's a coffee cooperative in Burundi. And so the monetary policy today of the national bank makes it impossible to repatriate your hard currency. So we're unable to work with them.
I want to talk a little about both of you about how you raise your capital. And Jovitas, congratulations. Recently, you received a commitment from the MasterCard Foundation Africa Growth Fund. And I was just kind of curious, like how there's so many funds competing for that capital. Why do you think they chose SIF? Like what was specific about your model that attracted them to you or you to them? And any details about that investment that you can share as far as whether it's first loss, or whether it's pari passu, the tenor, the rate that they're looking for, etc.
Thanks, Sangbei. The reason why the factors that led the MasterCard to be attracted to invest in our fund is that they are interested in the real economic growth of rural businesses. And
what businesses?
Rural
businesses. Got it. Yeah.
So we are typically doing that, and there are factors that they have identified in their criteria that this includes financing, it's gender inclusion, youth inclusivity, food security, and changing the total change of rural economics.
And a lot of these foundations, donor supported activities, I think there's kind of a double-edged sword. If they're providing necessary capital, but they have all these restrictions, which makes it challenging. I don't know if you feel comfortable talking about that. Do you think it's something that donors should keep doing and then you benefit from it, or they should make it more unrestricted and just say, you define the kind of development impact you're having, and if we think you're doing a good job, then we'll support you with our capital?
Yeah, it depends on the interest of the donors. If they are impact first, obvious, they will be passionate and support the supporters, because once we develop these rural businesses, small scale, they grow into the high level. They improve the standard of living of the smallholder farmers. And as you know, in East Africa or Tanzania particularly, that the almost 80 to 90% in the small scale farmers. And that's if you are willing to, if your ambition is to grow the rural economies, obvious that is the best fit investment.
Thank you. So similar question, Wouter. You received a $1 million. First of all, I'll make clear that for SIF, it was an investment from the MasterCard Africa Growth Fund, and they wanted development impacts. For Wouter, for Kampani, you got a grant from the Belgian government to be used as first loss specifically. So what does first loss mean, and what's the goal that the Belgian government had by giving you that money?
Thank you. We are the only fund, Belgian-based fund, to have received such a grant, and they chose us because of the niche that we occupy. And the Belgian federal government has understood that what we do is exceedingly rare, and very valuable, and it needs to be scaled. And their thinking was that with when we talked earlier about the challenges of the niche or the choice of the investment strategy that we made determines the risk return ratio that we can offer our shareholders. And how can you improve that? It's by systematically de-risking the proposition. And so by inserting this first loss grant or this first loss tranche, we make it so that investors in Kampani, for every 100 euro you put in, Kampani would need to be underwater for more than 5 before the investor loses his or her first euro. So it protects the downside risk for the investor, and has been incredibly successful. When that grant was awarded, we were a tiny fund of just 4 million, and so that's 2 years ago, and now we're at 15 million. So in terms of convincing additional private capital to join Kampani, this has made a massive change.
Yeah, so that's interesting. So I think, for SIF, the money came in because they had development impacts they wanted from the money actually being deployed. But for Kampani, the money came in because they picked you because of the development impact you had, but they wanted you to use their money to attract additional capital by making a better risk return profile for those other investors to come into the fund.
Exactly.
So this is to me, it's like this is I'm reading. So SIF, it was great reading reports about you. You guys are both sharing a lot of information, which it makes it easy to learn. And this is something I was looking forward to asking you, Jovitas, about SIF. So in you did a report about whether to expand into other countries, Uganda and Kenya. And in that report, you did a segmentation, which I also always love, and of SMEs, and there's 4 different types. And you chose one. You chose something called, most of your borrowers are what are called livelihood sustaining enterprises. And these are described as informal family-run businesses on the path to incremental growth. So what you did not choose to focus on is another group called high growth ventures, disruptive business model targeting large addressable markets with high growth and scale potential. So I was just curious, why would a fund choose to would focus on businesses with incremental growth versus those businesses with scale potential?
Okay, thank you. Our interest is not to finance the sustainability of the self-sustaining businesses. That's just the character of the market niche that you are targeting. But we didn't decide to finance them just because of their reliability. On sustainability. Our interest is the missing middle. To finance the missing middle. These middle entrepreneurs who cannot be, who the microfinance financing is low, and the financial and return, financial lenders are too high for them. Only to find now that the group we are financing is falling under such a category of.
So that makes sense. So that leads to the point that I want to also bring up, where you're located. Not only are you in only Tanzania, but tell us where in Tanzania you are. I mean, a lot of funds will talk about Kampani based in Brussels, and you are based in Tanzania, but you're not even in the capital.
Yeah, sure.
Where's your office, and why are you located there?
Our office is in just in the northern zone of Tanzania, that's Arusha. But we are serving the whole country, the whole region, most regions of the country. We are traveling from one place to another, from a region to the region. But remember, the type of the entrepreneurs we are serving are in rural areas. So we travel.
They're what?
They are in rural
Okay, right.
areas.
Yeah, they're rural areas, right.
And of course, since agriculture is done on a basis of nature, there is no big scale farming. They are depending on rains and arable lands. These are also divided in 2 regions. They are not in capital. So even the investment, the entrepreneurs, middle entrepreneurs, investing nearby the sources of raw materials, which is up country, not in the capital.
And so when you say that the character of the market you're targeting, that's where the livelihood sustaining enterprises are located, are there high growth ventures in Tanzania, or are they in the capital, or really maybe that's a market that's very shallow in the whole country?
Pardon?
High growth ventures, are those type of businesses, I think we're saying they don't exist in rural areas. Do they exist in the capital?
Yeah, sure, they do.
And why wouldn't SIF decide to move to the capital and target those businesses? And I'm asking this from the perspective of a donor. Let's say there is a fund targeting high growth ventures in the capital, and then there's SIF targeting livelihood sustaining enterprises in rural areas. Which one should I care more about? Or if I had to choose one, which one would I pick?
Yeah, your choice will depend on your interest. If it is financial returns, obvious, you won't choose us.
No, great answer. Exactly right.
Yeah, but if you are
those scale potential companies, right, people are going to be charging more for them, and they're going to be looking there. Those are probably equity investments, and they're probably sophisticated enough that you can negotiate those and provide you with a higher return. Okay, great. So on that point, Wouter, you decided to go global, and I've known your size is not small, but it's not large. And I've seen other funds really have challenges being spread so thin. There's this benefit and this cost. Why did you guys choose to be global, and are you going to stay in that direction after the experience you've had?
Yeah, no, that's a valid question, of course. We're in the 3 continents, but ultimately we're currently in 14 countries, and we're likely to stick to no more than 20 countries. So in terms of number of countries, number of geographies, political situations, etc., we believe it is manageable. But the true answer, Songbei, is that when we created Kampani, we wanted to be very opportunistic. We weren't even sure that the types of deals that we are after even existed. It was real pioneering work with what we did at the outset. There were a lot of questions around, in terms of our deal origination, for instance. Maybe a quick aside on this. We source our deals by our own shareholders and partners, and so it was a real question at the beginning. Are our shareholders, so typical TA providing NGOs, are they going to be equipped to filter and sources the deals that are bankable, that meet our criteria, etc.? So we had to really, our niche is very narrow in many ways, but in terms of geography, we felt that we needed to keep our options open. Yeah.
Okay, thank you. Now I'm going to speed it up a little bit because I want to just get to a couple more questions. One, I did say I'd promised to ask from the LinkedIn post was from Nyembe Chapeshamo, I think a short answer. Will either of you be working in Zambia?
We would like to be,
Okay.
but so we want to build a pipe there and develop a network there with partners that can de-risk our investment and that help us with our determination. Yeah. So we are interested, but we need to build a network.
And Jovitas, are you any plans to expand to Zambia currently?
Not.
Okay, I think. And then the 2 last questions I'm going to ask before looking at the questions coming into the chat, just to let you know in advance. One about rates, and this is a lot of interest here, and the second about just measuring impact. So the first one is, both of you, can you talk about the rates you charge? Because for Wouter, I read somewhere that you look for a 10% return on investees. I'm not sure what that means. If that's, maybe you could tell us, what is the return you look for from your borrowers, and how much do you look to pay your investors? And similarly, for SIF, in your report that I read, the expansion study, it says that you offer a rate of 18 to 20%, but the breakdown later in the report shows that the cost is 31%. So I didn't know how to reconcile that disconnect. So basically, why don't you just explain how much you charge and how much you pay your investors? Maybe we'll start there.
So for Kampani, since most of our portfolio is in subordinated debt, so with an interest rate, it's easy to answer that question. Our interest per annum is from 8 to 12%. That's the range.
Is that dollars or local
This
currency?
is hard currency. Yeah.
And are your borrowers typically earning hard currency?
Well, we would get into quite a lot of detail. So if they don't, we charge more. And so if they do, it depends on the currency or the monetary policy. Is it a crawling peg? Is it a fixed peg?
Okay. And do you do any hedging on your side or no?
No, we don't hedge.
Okay, no hedging.
And we will always put the currency risk with Kampani. That would be unfair, I think, to put this with the client. In terms of the return net for investor, we target inflation plus. And so far, we're on target to do that. Yeah. It's
inflation, I guess Europe inflation, not US inflation.
Yeah, the average of the past 10 years. So we don't have.
10 years. And you say inflation plus. What's the plus?
The plus is the aspiration to do a little bit more than
okay.
It's never gonna be an IRR of 7-8%. That's impossible.
Yes, I understand. I've heard black break even. So break even, but break even to the black versus the red. Okay.
Yeah, that's the plan. But now I mean, it's a fragile business plan what we have. I want to be quite transparent about this. If we indeed charge 11-12%. And knowing that our fund management cost is around 7.8%, that doesn't leave a lot of margin to pay for failures. So we are running a tight.
And Jovitas, Martin, Susan specifically asked, how do you bring down that 10% cost of funds that goes into the 31% cost that goes to SME? But the other question as well, is 31% what your borrowers typically pay, or is it 18 to 20%?
Okay, we have increased the interest rate, not like as we started after realizing that the costs are so high, and we are not able to break even. But however, we are struggling to do that by trying to upscale. Now we are trying to bring in bigger loans, and of course we try to benefit. I mean, to earn through economies of scale by producing more loans. Yeah, that's how we're trying, but in the meantime, we are not breaking even or making profit. But
okay, so when you're saying you raise the interest rate so SIF can break even, is that what you meant?
We believe so, but it's a combination of factors, not only by increasing interest, but also by trying to provide to avoid it, because the most cost drivers are the currency losses. We have the origination costs, and so we are trying to do, and the origination cost is high because we know we are dealing with the most informal market niche. So we are trying to apply, give some BDS, business development support, and technical assistance, so that at least our entrepreneurs can manage well their cash flows, and therefore by so doing, they can repay well their loans, and therefore we avoid the provision costs and recovery costs, but also the origination becomes cost is reduced by if our entrepreneurs are well prepared and borrowing ready.
Okay, thank you, Jovitas. I'm going to ask you now. I want to just ask a few questions for folks in the chat. You can decide which, if any of them, either of you want to answer, just so we can go through. You can get an idea what people are asking. This is very specific. For small ticket sizes, is it better to find it? Okay, I didn't really understand that. Let me go down. Okay, this one says, Wooter, can you further explain why doing quasi-equity over long term for an average exposure still cannot make commercial returns? Another question. Let me just ask a couple more, and then I'll pass it back. Do either of your approaches work in fragile contexts? For example, Myanmar. And lastly is question technical assistance. What part of your model, what kind of role does technical assistance play in your model? And these questions were asked from Weem Del Jowood, Tet Hut Ang, and Matt Ganazini. So the first question is specifically to you, Wouter, and then the other two, I open it up.
Yeah. So thank you. So commercial returns for our investor is a complete non-starter, given the choices we've made, where really we start from the social impact, the social ill that we want to address, and reverse engineer a solution for it. And that solution has to imply that investors are okay with breaking even, doing inflation plus. And the simple reason for that is that the transaction cost, the origination cost, all of those costs are simply too high relative to the ticket size to then on top of that promise a return, an IRR of 15-16%. It's a non-starter. Fragile context, yes, very much. We, in fact, if you break it down, our portfolio, about a third will be in LICUS countries, in low-income countries under stress. We are in Congo, we are in Myanmar indeed, we are in a number of geographies, we're in Burkina Faso that show a high country risk. TA, very quickly, so we have a little bit of TA, not very much, but this is in the direct sense of the word, meaning money that we manage and deploy ourselves. The strength of our model is much more on the indirect side. It's that multi-stakeholder model that we talk about at length in the SSIR article. It didn't come up yet today too much, but so we are never going to invest alone. Our relationship with the client extends always to our partners like NGOs, social lenders, sometimes a foundation. So there's always other organizations involved, and through the core business that they do, provide support, or so that we approach our clients from a variety of angles, and we do that in a coordinated fashion. And it's been a successful, or it's been a crucial factor in our success rate. We have had we're at 20 deals, and we've seen no failures. None of our companies have gone bankrupt. We've had to restructure a couple of loans, but we have not had to write off anything, and that is really much better than what one could expect given our niche. So quick couple of answers to these questions.
Anything to add, Jovitas, maybe on the fragile context or technical assistance? Maybe on the technical assistance?
Sorry, pardon?
Do you provide technical assistance as part of your model?
Yeah, of course. What we assist the clients is basic bookkeeping by keeping the records, so that helps us in translating and interpreting their financials, but also some little formalization like open companies and compliance. Yeah. Those are the
So that bookkeeping, is that something that you provide as a service? Do you consultant comes in, or you pay them money to buy a bookkeeping to pay an accountant? How does that work?
Previously, we had a fund, and then we started offering it free at our cost. We had a fund which was supporting, but then it died up. Then we started a cost sharing that the clients could contribute at from the beginning, and they enjoyed that. Currently, we are not so much, though. We are now sourcing the fund to start it.
Okay, great. And Wouter, I'm glad you got to talk about your stakeholder model. We did not have a chance to address it earlier, but definitely recommend people to read the SSIR article to learn more about it. And also, the person who asked the question about technical assistance, I know him, and he works at an activity called Snoop, which provides technical assistance, multi-donor, multi-fund, SSNUP. Definitely check it out if you're not already aware of it. I'm going to ask a last question before I and then I'll let you both give any closing remarks. So both of you, I think portfolio, call it, I think 10 to 14 million euro for Wouter, for Jovitas, dispersed $15 million since inception in 2013. So you've had, it sounds like, great impact, but at limited scale compared to other types of investment funds that might be more commercial. So my question is this a niche activity? Is it something that can scale? How interested should donors be in supporting these type of activities? Answer that question, and then anything else you'd like to say in your closing remarks.
Shall I go first?
Sure.
Yeah.
So obviously, well, is it a niche? Yes, it's very much a niche. And one of the struggles that I have is that a lot of funders or donors look at an investment fund and, it's investing in AC in Africa, and, they don't necessarily go much deeper. And they are really, what Kampani is a niche fund in that what you need in terms of skill set, the nature of the dialogue that you have with clients like ours, they often are these farmer leaders have very little formal education. Metaphorically, they don't speak our language. Huh? So it's really this ability to communicate with our clients in a way that, you can really have a useful conversation. This is not something that the type of activity that we do, if you look at a DFI in terms of procedures, in terms of skill set available in with the staff, etc., they are not really equipped to do what we do. This is what I've come to really be convinced of. So yes, it's very much a niche activity, what we do. Is it scalable? Yes, absolutely. In terms of the demand, there's far more demand for what we do than what we can do. It is in fact quite easy to scale. Of course, at a certain point, we target a 20 million fund size. That means 50 to 70 deals in portfolio. So ultimately, there's a limitation to what you can to how usefully you can scale it within one fund. But of course, nothing prevents you from splitting off into different funds. So this is eminently scalable. Of course, you want to also scale the network. You want to scale the de-risking side of things. So maybe for me, the last thing I'd like to say is when anyone looks at what we do, all of us as funds, we're always struggling with the same challenges. And it's the client acquisition cost, the transaction cost, the monitoring cost, and then the risk, the credit risk itself. And so I believe Jovitas and I we had a great opportunity to share our approach. We believe for Kampani that our approach is excellently suited for the niche that we occupy, and we invite a lot of other funds to join us. There's a lot of work in this segment. So I'll leave it at that. Thank you for having me. Thank
you, Wouter. Jovitas.
Yes, and it's true. It's a niche thing. It's the mandate of the investors, but we are also, like I said, it is a scale up. As I said, we are trying to scale up so that to be sustainable in the market.
Great, thank you. And so I just will highlight on a few points. The right product. So there is not the right product, appropriateness. It's not going to be the same product for every market for what you want to target. Like Jovita said as well, if you want to go for returns, then you might target a different segment. But for the segment that they're targeting, you need to have the right product, make sure it's appropriate. You need the right investors. They have to be aligned. If you're going to be mission first, impact first, you need impact first investors. So you're not going to get, you don't want a commercial first investor because they'll steer you or force you in a different direction. And third, donors, I think, and the message I get here, we focus too much on risk. There's only a certain amount you can de-risk to. There's going to always be this cost we overlook to serve, especially rural markets and small transaction sizes. And that's something I think Aceli has been really innovative in trying to address that issue. And finally, I do really think about this question of scale differently, especially with the type of work we're doing. I think that you guys are doing exactly what we should be doing. You're experimenting, you're innovating, and we can learn from this. And maybe your own funds won't scale to billions, hundreds of millions or billions, but the lessons we'll learn will be important for others to replicate or for other activities to adopt when they expand. Because we know that even if you grew, you wouldn't be able to do it by yourselves. So thanks again, and let me pass it back to you, Nadia.
Thank you so much, Songbei, and thank you to both of the panelists. That was really interesting discussion. I certainly learned a lot. So the recording will be available on the Safin and Market Links websites if people want to listen to it again or share it with others who weren't able to attend and might be interested. We also invite you to join us for the next 2 sessions. So next one will be a conversation with donors and will take place in late March. So with that, thank you for your participation. Thank you again to the speakers. Songbei, thanks very much. Have a great afternoon.